Good morning, everyone. I am Saida Sadia Tehreem, second year BBA, St. Philomena's College. A very warm welcome to one and all present here. Today, we all have gathered to a webinar on a very interesting and important subject. I'm sure you all would agree if I say that certain standards have to be maintained in every areas which we handle in our day-to-day life. Accounts and accountability is one of the most critical subjects in our life. But unfortunately, time and again, majority of us have failed to maintain such standards. In the light of this, today's webinar is about Indian accounting standards. And the end of the program, when we walk out, we carry rich knowledge about the subject. I wish you all a very pleasant and happy time in this webinar. I now call upon Maria Sahana, first year BBA student, St. Philomena's College, to address the gathering.
Good morning, dignitaries. Myself, Maria Sahana, first year BBA student, St. Philomena's College. It's my pleasure to welcome everyone to our webinar. First and foremost, I would like to welcome Reverend Dr. Bernard Prakash Barnes, Rector Manager of St. Philomena's Educational Institutions. Welcome, you dear Father. I would also like to welcome Maria Xavier, Vice Rector, and Reverend Father John Paul, Campus Administrator in their absence. I also welcome Father Julian of St. Philomena's College. Welcome, you dear Father. I also like to welcome Dr. Alfonso de Souza, Principal of St. Philomena's Degree College. Welcome, you dear sir. I welcome Professor Vidyadhar Sanjay Nair, Vice Principal of St. Philomena's Degree College, Mr. Ronald Prakash Coutinho, IQAC Coordinator of St. Philomena's Degree College, Dr. Reena Francis, the Dean of Commerce and Management Department of St. Philomena's Degree College. Welcome you, ma'am. I also welcome our special gratitude to our resource person, CMA Dr. Trinisha TR, who joined us online. I also welcome our HOD and staff of BBA department. Last but not the least, I would also like to welcome all the participants who have joined and will be joining the webinar. Welcome you one and all.
Thank you, Maria Sahana, for welcoming the gathering. Now, let us inaugurate the webinar by lighting a lamp by our dignitaries along with the prayer song.
I come before you today, and there's just one thing that I want to say. Thank you, Lord. Thank you, Lord, for all you have given to me, for all the blessings that I cannot see. Thank you, Lord. Thank you, Lord. With a grateful heart, with a song of praise, with an outstretched arm, I bless your name. Thank you, Lord. I just want to thank you, Lord. Thank you, Lord. I just want to thank you, Lord. Thank you, Lord.
Series. I'm extremely happy and delighted to tell you that today we have a very eminent keynote speaker to share his light and share his experience on the subject. He is a very eminent scholar, perhaps require no introduction. But yet, to formally introduce and welcome him, I would like to call upon Nikhila, second year BBA student, St. Philomena's College, to welcome our resource person, CMA Dr. Trinesh TR.
Good morning, everyone. I'm profoundly delighted to take an opportunity to introduce the resource person for the day. He is none other than CMA Dr. Trinesha TR, Assistant Professor, Maharani's Women's College. He is also working as the chairman of ICAI with MCOM and MBA. He has 16 years of experience in total, 5 years as process associate in investment banking in derivative documentation, and 11 years as assistant professor. He is highly self-motivated, enthusiastic, and professional with excellent teamwork. Also a dedicated problem solver with excellent analytical communication and interpersonal skills. I welcome you, sir.
Thank you very much.
Thank you, Nikhila. I now request CMA Dr. Trinesh TR to kindly take over.
Yeah, well, good morning, everyone. Thank you for a nice introduction about me. Respected management of St. Philomena's, father and principal of the St. Philomena's, and delegates and faculties of different universities and colleges, and also my dear student participants. I will take this opportunity to throw a light upon Indian accounting standards through this webinar, where let me present the highlights of this webinar, where we will be discussing about applicability and adoptability of Indian accounting standards and its convergence with IFRS, and also how IND, otherwise Indian accounting standard, are different from IFRS with some carve examples and illustrations. And also we will be discussing about how Indian accounting standard is beneficial to various stakeholders of our country and economy as whole. And also I will be in the position to make you to know about, as an introductory part, what are the Indian accounting standards which are converged with IFRS, and what are the list of accounting standards they are still in the raw status, that means as in the customs manner. Before moving to the to know about applicability of Indian accounting standards, let me give some introduction about, otherwise a background of this today's webinar, where about IFRS. Otherwise, these are also to be called as converged IFRS. Indian accounting standards can also be called as converged IFRS. At the present context, we are living in a global village, right, where accounting language, that means a common accounting language, is very much desired and should be communicated in an understandable manner for all the stakeholders, okay, across the world, and also because of generally acceptable accounting principles, for example, concepts, conventions, and accounting policies, okay, and its applicability and adoptability in preparations of financial statements. These should be reflected, and also in has to be in the understandably uh, at the global context. And as a result of these requirements of the compliances and as well as the what do you call the stakeholders in India, Indias are being developed and they are being in the developing process. There are around 16 Indian accounting standards which are converged with the IFRS, and Indian accounting standards are an outcome of converged with IFRS, as earlier mentioned, as a common accounting language. That means incorporated all Indian accounting standards while preparations of financial statement or books of accounts. And to brief on this particular introductory part, where IFRS is meant, this is applicable for European countries and worldwide except US, where for US there is a separate accounting standards called US GAAP they're following. However, if at all, we would be having multinational corporations and any sort of business combinations with the European countries and like including UK, there is a must to have IFRS. Otherwise, at least we must be conversed, having the conversed in days with us. Okay, and now, coming to the applicability and adoptability of Indian accounting standards, where these standards are generally issued by the Ministry of Corporate Affairs, where the controlling and supervisions will be done by the Accounting Standard Board of India with the consultation of ICI, that means Chartered Accountant Institute, and also there is a National Advisory Committee is also there to look after the formulations and designing of these accounting standards, where these accounting standard committee generally consists of, as I earlier mentioned, the Chartered Accountant Institute, and also along with the various government departments like, and in addition to that, academicians, professional bodies like CS Institute, and also Cost and Management Account Institute, or their representative from Association of Chamber of Commerce, Confederation of Indian Industry, and FICCI. Okay, these are all the players who are there to look after while designing or standard setting process to recommend the same once they are in the once the accounting standards are converted into a structured way to the Ministry of Corporate Affairs for implementation. Okay, this is about applicability of Ind AS, where if you continue with like that to know about the basics of these applicability, where the initially the Ministry of Corporate Affairs in 2015, which has come up with the notification on 16 February 2015, as which has been restricted, I mean stipulated and and which made compulsory that adoption and applicability of Ind AS has to be there in the that is applicable from accounting period of 2016-17. Okay, where Ministry of Corporate Affairs, which has issued the 3 amendment rules effective from 2016, 17, 18. Okay, as in the 2015 rules. Okay, these particular Ind AS are meant for have been in the manner of harmonized with the IFRS. That means whatever we incorporating Ind AS accounting standards, these are all very much harmonization in the sense uniformity has to be maintained by taking off all the aspects in related to accounting standards which are stated in the IFRS, and the same has to be reported by all Indian companies for the global axis. And when we speak on applicability and adoptability, this has been done in the different phases. Oh, okay, here there are the what you call the adoption and applicability is generally is based on the net worth and listing status of the companies which are in the which are in existence in India. And first we'll take up in the first phase there was a mandatory applicability for the companies from 1st April 2006. This IND AS is very much compulsory for this category of companies where the company is whether listed or unlisted, where the net worth is greater than or equal to 500 crores. And also, in addition to that, the subsidiaries companies and parents company, and if any associations or joint venture companies are also supposed to have these IND accounting standards mandatorily. Okay, and for computation of net worth, it will be verified based on the immediate past, previous 3 years, to say 2013, 14, 14, 15, and 15, 16 years net worth status will be taken into consideration to bring the particular company to have this IND AS mandatory. And in the second phase, it extended its mandatory applicability for having this IND accounting standards to all companies, which is effective from 1st April 2017. And then as based on the listing, when their status as on 31st March 2016, whether it is a listed company or it may be in the process of listing, and where its net worth should be at least equal to 250 crores or less than 500 crores. Okay, these company have to be get compulsorily to follow the Indian accounting standards while preparations of their financial statements. And the same is applicable for their listed company or the unlisted company, or the companies may be in the listing process. Their parent company, or it means subsidiary company or associations or joint venture of these have also to have this adopt this IND AS. And for this purpose, net worth has to be calculated based on the previous immediate financial years of last 4 years, in fact, where effective from 2013, 14, 14, 15, 15, 16, and 2016, 17. For all these 4 years, the net worth will be verified. If the net worth exceeds 250 crores and which is maybe less than 500 crores, then these particular companies have to mandatorily have these Indian accounting standards. This has done in the second phase. And at the third phase, the banks and non-banking financial corporations, and including insurance companies, are bring into the purview of these Indian accounting standards effective from 1st April 2018. Suppose the conditions to bring these particular categories of banks, NBFCs, and insurance companies, so their net worth should be at least 500 crores or more than that, effective from 1st April 2018. And this net worth, what do you call, ceiling limit is limited, which is applicable for IRDA, that means Insurance Regulatory Development Authorities, and for the banks and insurance companies, okay, which is effective from 1st April 2018. And as we know that non-banking financial corporations, to give an example, Koshammattam, what do you call, Manapuram, not Manapuram exactly. There are no NBFCs like Manapuram Gold. Okay, even that can be stated as an example. If these companies net worth exceeds rupees 500 crore, then those have to be, and including stockbrokers and venture capitalists, also have to compulsorily have their books of accounts in the stated manner as designed under the Indian accounting standards. And for the purpose of calculations of 500 rupees net worth, it would be considered based on the last 3 years financial performance, where 2015-16, 16-17, and 2017-18, because it is coming effective from April 2018, so that immediate 3 years preceding to from the date of otherwise from the financial year of effect will be taken into consideration. Where we were speaking about net worth. Okay, how net worth can be calculated. Okay, net worth is the combination of, okay, which is include exactly paid up share capital and all sorts of reserves out of profit, and also securities premium amount. And in addition to that, There are capital reserves, if any, arising out of promoters' contributions, and government grants receipts also have to be included, if at all they're in their business affairs. And at the same time, that has to be reduced by accumulated losses and any deferred expenditures and any miscellaneous expenditures which are not been written off, and also that has to be excluded from the aspect of reserves created out of revaluation of assets, and if anything return back depreciation amount is there, that should be excluded while calculating net worth component. Okay, this we need to understand. And voluntary adoptions is there, where a company can voluntarily adopt the otherwise incorporate its Indian accounting standards in preparations of its books of accounts, which is effective from 1st April 2015 onwards. Okay, where there is a requirement where this reporting such companies must include the comparative report for the period in 31st March 2015 or thereafter. It's happening, not happening. 1 minute. Can you see now? Yeah. Right. We were speaking on voluntary adoptions, where a company can come forward without any of the stipulations, otherwise it may not meet the net worth as stated above. They can come forward to have their books of accounts as per the Indian accounting standards in their report. However, these companies must have to include the comparative report for their period of 31st March 2015 or thereafter. And once these companies, that means those company would like to have the voluntary adoptions, have started their reporting as per the Indian accounting standards, they are not allowed to change their reporting as per the previous laws. Can you see? Right? Okay, fine. Now we look at the role of accounting standard board and how exactly the standard setting process will takes place. Okay, where standard setting process which would balance these various different factors which would affect on the standard setting process. For that, accounting standard board will taken care of, where it would consider very importantly, very crucially, these accounting principles. We should not ignore the accounting principles like conventions, concepts, okay, whatever we understood in the graduation level, otherwise in the basics of accounting, those need to be considered and incorporated. And while designing these standards, the legal requirements should be taken into consideration, because in every state, a law is, state in the sense, in every country, the legal requirement supposed to be, we have to follow. Like, in India, Indian Companies Act 2013, we have to consider while designing these, developing these Indian accounting standards, and we have to keep in our mind that the security laws as well, and various other laws like Foreign Exchange Management Act, FEMA, and these things need to be considered while we designing the standard setting process. And cost and benefit considerations. Okay, just we are not designing just because of the of our purpose being when we will be able to seek the foreign funds, otherwise foreign institutional investors, otherwise for not compliances. Not only for these aspects, we must have to keep in mind that what are the benefits and what are the costs associated during the process of standard setting. This also has to be keep in mind during the course of activity. And also industry specific issues also have to be addressed. Okay, we know that there are service sectors, there are manufacturing sectors, there are n number of various other ancillary services providing in institutes, otherwise industries. Okay, we have to consider their issues while designing the standards. And always we have to be keep in touch with that. Is there any evolutionary change is very much required? Okay, if that is the case, those things need to be considered, and the implementation issues has to be in due course. We have to give importance how to handle and how exactly the implementation has to happen. If any sort of issues arise, how to overcome those issues also have to be discussed during the process of standard setting. And then now coming to the IFRS, okay, because we have to inevitably understand about IFRS, because whatever we are now following in the form of Indian accounting standards, these are all the derived out of the IFRS standards only, where we need to understand the basics of IFRS, where the objective of this IFRS is to provide, otherwise to prepare the financial statements by having the common rules, and to achieve the consistency and transparent and comparable. It is very important. Consistent in the sense accounting policies, otherwise concepts and conventions and the methods of valuation, whatever it may be. Okay, those things have to be continuously followed with the same methods. Otherwise, it is very difficult for comparability, and also the transparency always should be there. Transparency can be achieved by these standards only when the disclosure policy have to be there within the standards. So wherever the notes, otherwise wherever the disclosures requirements and valuation requirements has to be reflected, need to be shown in the financial statements, have to be stated in the books of accounts so prepared. So that gives the decision making kind of thoughts to the investors, and also for the competitors and for the government for the taxation purpose. And as I said, the comparability is very important. Okay, how comparability has to be achieved in IFRS means when all different nations would follow this IFRS commonly, then exactly we can say that books of accounts so prepared by the different countries, those are situated in the different nations. Okay, those companies are established in different state, the world across. They can easily comparable because every every company will be following the same accounting standards to be called IFRS. Okay, specifically these IFRS are generally issued by the International Accounting Standard Board, which is located in London. Okay, and they specify that how exactly these companies have to maintain the books of accounts and prepare their reports, and also they have to define the what are the types of transactions, how each and every transactions as stated in the IFRS have to be stated in the incorporated in preparations of books of accounts. Okay, and other events also have to be stated, which if at all they are impact on financial matters. Okay, these are the IFRS are the common accounting language. Okay, it's a communication for the all people, otherwise stakeholders who need informations in the form of accounting when they look at the balance sheet, otherwise financial statement, or the position of the performance of the company through these accounting language that has to be generally acceptable, and uniformity has to be maintained, and as well as the understandability also should be there. So these are created based on the common accounting language, and so that these business and financial statements can be called as they're consistent, and we can rely upon these standards where company and company to company, or it may be one country to other country. There are at present, okay, out of 41 international accounting standards, okay, these IFRS are derived out of the international accounting standards, where previous to this international accounting standard board, there was a international accounting standard committee was in existence. Okay, that was look after designing of international accounting standards. Now by substituting, by taking these International Accounting Standard Board is this has taken over these International Accounting Standard Committee, and these are designing the international financial reporting standards. Now we can see out of this 41 IAS, 17 IFRS are in existence. So this is about Indian accounting standards. I already been mentioned about the structure of Indian accounting standards, how the body of Indian accounting standards will be formulated based on the Accounting Standard Board, where it was constituted in 1977 with the help of Chartered Accountant of India, where other representatives from the government department, academicians, and other professional bodies like Institute of Cost and Works Accountant of India, CS Institute, and also representative from Association of Chamber of Commerce, CII, etc. Okay, these Indian accounting standards are, as earlier mentioned, these are the converged with the IFRS. These are all derived from the IFRS. We are not exactly copied everything from the IFRS. However, we have carved out while converging. That means we are not adopting the IFRS exactly. Instead of that, we are converging. Okay, that means if some significant changes are required, means then we will done through the carve outs while converging out. That means what exactly carve out while during in the course of convergence, this particular activity will happen means when we look at the IFRS, okay, it looks like an ocean. It looks like a general larger, and we will be taking only something which we would like to change in the Indian accounting standards with all our efforts and difficulty. Okay. Let us throw light upon what are the carve outs. That means this exactly gives what are the different, I mean, in certain aspects, how IFRS and IND AS are differently, they will be having their, they will be tuning up their accounting standards. IFRS are the standards which will be generally applicable across the world. However, while designing Indian accounting standards, certain things will be taken from the IFRS, and we will, according to our local policies, economic policies, and also the compliance requirements of our domestic nations, then we need to tune up accordingly as per our requirement, This has to happen. So that let us take some of the examples where how the IFRS and IND AS are slightly varies and how they are different from each other. Where regarding component of financial statements, that means what are all the things which are included to be called it is a financial statements. Okay, we prepare financial statement generally in IFRS and as well as Indian accounting standards. However, in IFRS, the statement of financial position, statement of profit or loss, and other comprehensive income, that is very important, that will be there. Okay, it is all about other comprehensive income statement is like the revaluation of assets and also the transactions related to actuarials and also the transactions related to derivatives. Okay, these will be in addition to the normal financial statements, comprehensive income statement will be included, all these. And a statement of change in the equity should be prepared as per the IFRS requirement, and statement of cash flow for the year. These are all together to be called as a financial statement components as far as IFRS is concerned. In IND AS, more or less, as in IFRS, all financial statements will be maintained, and we will be interchangeably, we will call the statement of financial position to be termed as balance sheet, that can be seen, and statement of profit and loss account has to be maintained as in IFRS, cash flow statement, and this particular cash flow statement is not applicable for the small and medium scale enterprises, and change in equity statement has to be prepared. And one special thing we can observe in Indian accounting standards, where notes to accounts, otherwise financial statements, and disclosures of significant accounting policies are very much required. Okay, we will be discussing about what are the notes exactly to be there stated in the accounts in the upcoming slide. And very importantly, in Indian accounting standards, Even in IFRS, there is a disclosure significance accounting policy should be there, but not as in Indian accounting standards. We can't find this disclosures aspect in the IFRS. I mean, this is also related to carve out how these. I mean, what are the important aspects we are picking from this IFRS, from the larger part of the accounting standards and whatever the I mean, within which is there in the whole particular standards stated in the IFRS. We will be picking some of important thing and with all sort of greater efforts and difficultiness. That's what's carve out we are talking. I mean, when we look at the differences as far as business combinations related to business combinations between the IND AS 103 and IFRS. Okay, in IFRS 3, business combinations will be stated. Okay, and in as far as in Indian accounting standard 103 states that what is all about business combinations. This is the accounting standard, where in IFRS, profit and loss account has to be recognized the bargaining purchaser gain which is derived out of the business combinations. Okay, in any business combination there is always a bargaining purchase gain that has to be stated in the profit and loss account. That means recognition is very important. So in every accounting standards, whether it may be IFRS or international accounting standard or IND AS or otherwise Indian GAAP, whatever it may be, the structure of accounting standards should be always like this, where definitions will be always should be there, because the terminology of a particular accounting standards has to be understood in general manner, so the definitions will be there. And then very importantly, treatment, how we will be considered in the form of how the evaluation has to be made for each aspects which would be fall within the accounting standards, and also how the recognitions of expenditure and as well as profit has to be made, whether they are to be capitalized or to be should be shown in the statement of income or profit and loss account. Okay, these things should be explained. And finally, very importantly, a disclosures requirement will be there. Okay, here we are ignoring these all aspects, but I am taking only consideration of the bargain, how exactly the recognitions of these bargaining purchase gain out of these business combination will be done when we compare with the IFRS 3 with the IND accounting standard 103. When the same business combination and bargain purchase gain recognitions, how this will be going to happen in IND AS means where the same has to be recognized in other comprehensive income and accumulated in equity as capital reserve. So what is the difference we can see when I compare with the IFRS 3? Here, in addition to the, where in the previously in the IFRS, we are supposed to have the recognize the bargaining purchase gain in the profit and loss account. But here, the same bargain purchase gain has to be stated in the recognized in the comprehensive income statement, and the same has to be accumulated in equity as capital reserve. Okay, this is there. Otherwise, there is another options where if there is no clear evidence or underlying reason for these classifications of this business combination as bargain purchase, that means bargain purchase gain is there, but it is very difficult to trace out how much exactly the bargain purchase is derived out of this business combination. Then in such cases it will be directly recognized in the as an equity in the capital reserve. And further going ahead with the presentation of reconciliation, again we are comparing IFRS and IND AS related to reconciliations. Okay, when we do comparative periods comparison of the financial statements, there is always requirement of the reconciliation in the IFRS 1, where which requires opening equity, total comprehensive income, cash flow statement, closing equity of the different comparative period have to be reconciliation, so that that would explain how exactly the transition can be made from previous GAAP to IFRS. Okay, this is the IFRS 1 where we are moving at the stage where generally accepted accounting principle to IFRS. If that is the case, we are in the transition period. We cannot directly have the IFRS for the complex matter. Other than that, what we can do is, if you like to get into have the IFRS standard, initially we always have to reconcile the comparative period statements of equity, comprehensive income, cash flow statement, closing equity, etc. In India is 101, where it provides there is an option. Okay, option will be given to the companies where what they can do is a comparative period financial statement on memorandum basis. That means if they would like, they don't like to exercise this option, that means reconciliation, what they can do is they no need to provide a comparative, otherwise they need not to provide reconciliation of total comprehensive income, cash flow statement, closing equity in the year of the transition. Okay, there is no such a requirement in case of Indian Accounting Standard 101. But if they are like to disclose the significant differences pertaining to the total comprehensive income, and then they can be allowed to have these reconciliation as per IFRS. Okay, that means we can find there is some flexibility will be allowed to convergence at the time of the convergence to the Indian Accounting Standards process. Okay, now, and also we have to look at the from the context of how the Indian accounting standards are different with the existing accounting standards. Okay, I will take up the accounting standard 1, where in Indian accounting standard 1, it is generally deals with the presentation of financial statement, which where accounting standard, existing accounting standards was only which would focus on disclosures of accounting policy. See the differences. Okay, when in accounting standard 1 of India, it is related to presentation of financial statement. It speaks on, however, accounting standard will speaks on much concentration of disclosures of accounting policy. Where in accounting standards 1, there is always a scope for comparison between and also difference between the present standard, which is not possible in fact. Okay, however, the majorly the requirement as laid down in the Indian accounting standards are like this, because we are much concentrated on presentation of financial statement rather than the disclosure of accounting policy. So what observation we can do here in the presentation of financial statement, where when explicit statement in the financial statement of compliance with all accounting standards, okay, it may an requirement of an enterprises where it can further Indian accounting standard 1 allow deviation from requirement of accounting standard in case of the, it is all about the desirability of the management, requirement of the management. If they think that there is a deviation requirement is required for the accounting standards, okay, what they can conclude is, okay, that compliance with the Indian accounting standard will be misleading. And if the regulatory firm, because what would happen is, if forcefully if we are going to implement some of the aspects in the accounting standards, that is not feasible, it may not be acceptable. Okay, if management thinks that if it creates any sort of misleading and it is it creates any sort of inflexibility and the hell, if that is the case, then regulatory framework then such which does not prohibit such departure. And in Indian accounting standards, which requires presentation and provides criteria for classification of current, non-current assets and liabilities. Okay, there is always scope for segregations of the current assets, what are the non-current assets and what are the current liability and non-current liabilities. These things will be clearly stated and presented in the we can find in the Indian accounting standard 1 as compared with the accounting standard 1, which is focused on disclosing aspects. And accounting standards which also prohibits the presentation of any item which is an extraordinary item in the statement, okay, or in the notes. Okay, this observation also we can make when we compare with the India's one with the existing accounting standards. Earlier I was mentioning about notes to financial statement. Okay, this is the new thing in the Indian accounting standards, where note should be in this manner, where it present information about the basis of preparations of the financial statement and specific accounting policies used. It has to be highlighted, and uh, also 11, disclose any information required by Ind AS that is not presented elsewhere in the financial statements, and provide information that is not presented elsewhere in the financial statement but relevant to an understanding of them. See, whatever we prepare financial statement is for the sake of the users of the financial statement. They have to make a lot of decisions as being a stakeholders. They may be a funding agencies, they may be financial institutions, there may be a lot of foreign institutional investors. They must understand exactly what are the true and fair view through the these have been stated in the financial statement. That can be understandable only if these financial statements should also accompanied with the proper notes. And an entity should also cross-reference if any sort of relevant note is there in the financial statement, that should be highlighted as in the form of cross-references. And disclosures of accounting policies. And as far as disclosure is concerned, entity should give disclosures of what are the measurement basis, what are the accounting policies, the entity which has been used while preparations of financial statements, and entities accounting policy has to be very clearly stated and will be presented. And disclosures also given in respect of what are the different accounting policies should sufficiently given in detail, and it has to be in the understandable manner. So we were talking about true and fair view. Okay, how true and fair view can be achieved means where in Indian, in India, Indian accounting standards are designed as per the to meet the compliances of the local legal requirements. That should be there in the any Indian accounting standards for that matter. Okay. In addition to that, additional disclosures also very much necessary. Through the proper notes. Of balance sheet items have to be stated if possible in the notes. If these things will be reflected along with meeting all compliances from the Indian accounting standard, that exactly we can say the designed accounting standards will give the true and fair view for the users of the financial statements. What are the idea behind Indian accounting standards and its financials? When you look at these, what is the motive or idea behind these means? That means an objectives of adoption or conversion. What purpose we are converging and adopting means? We always have to keep in mind the present value in the time value of money while recognizing, and also fair value has to be presented in every this thing. Fair value is exactly interpreted as the price that would be received to sell an asset or paid to transfer a liability in any orderly transactions between the market participants and at the measurement date. This is the fair value concept where this presentation has to be there. And recognition, as I said, time value of money. If any sort of the entry of a particular transactions, the recognition of the value so received or paid has to be recognized while considering the time value of money, present value concept. And also making the financial shock proof, that is through by recognizing uncertainties have to be expected, has to be incorporated, and also while providing the provisions. These things need to be disclosed. We may be expecting probable any sort of losses or any kind of provisions we are supposed to. There is no stipulations or restrictions to have these provisions. However, same provisions have to be given with the notes on that has to be disclosed with the disclosures has to be made with the proper reasons in the notes, otherwise disclosure requirements. Let us see how these adoption objectives can be reflected with the with an example. Indian Accounting Standard 16, which speaks on property, plant, equipment, okay, where we were speaking on valuation, where how valuation will be done. Valuation has to be done based on the fair value accounting, as I I stated that fair value in the sense the price that would be received to sell an asset, okay, or if we paid a liability while transferring such liability in an orderly transactions, okay, and that has to happen between the market participant and the measurement dates. Okay, this will be considered at the valuation part, and at the recognition step, where we can find the we can estimate the asset retirement obligations as a part of cost of assets, okay, where recognition of cost will be involved with the assets acquisition today itself. Whatever the cost we are, whatever it may be an imputed cost or the actual real cost, now it is happening, we have to recognize the same cost, okay, and we have to keep in mind the estimation of its retirement obligations also, that as a part of the cost of asset. And asset retirement of obligations, which has to be recognized at the present value, just based on the time value of money, and recognition of such cost has to be otherwise in the form of imputed interest cost of such provisions, or all have to be in the by considering the time value of money. That means discounting value has to be made. And after recognition, once valuation done, once recognition is done, and the same recognition will be that will be done with the due consideration of the discounted value as a measurement, and finally, and most for proponent of true and fair disclosures can be achievable. So that by doing all these activities, we can find the true and fair disclosures results. Now coming to the principles of Indian accounting standards. The principles generally, this is all about who are the users, who are going to get benefit out of these books of account, and what are the financial statements are supposed to be have in the while in the course of designing Indian accounting standards. Okay, here we know that the general purpose of these financial statements gives information about performance and what is its financial position, financial performance, and also the cash flows positions, and that is very much useful for the decision making purpose, that to financial decisions for the shareholders and for the creditors, okay, and financial institutions, employees themselves, and also the general public. These are the stakeholders who looks for Indian accounting standards, and that means the financial statement, they are all rely upon the financial statement so prepared by the companies at the domestic and also multinational corporations. Those are existed in local market, and for them, with the due consideration of these requirements, these stakeholders, okay, financial statements have to be prepared consisting of a balance sheet of the during the period end, and statement of profit and loss account of the year of the particular financial year, and whatever the changes is going to happen in terms of equity, that through the statement of preparations has to be done in the form of statement of changes in the equity, and also notes and comprising summary of significant accounting policy, disclosures items, and statement of cash flows. These are also prerequisites to be called as Indian accounting standard for decision making purpose, and comparative financial informations of the preceding period as specified when they would like to move on from old accounting standards or otherwise existing accounting standard to the new Indian accounting standards. Always there should be comparative financial information has to be given, and there is no voluntary for Indian accounting standards for the companies which are supposed to have the mandatorily, like based on the net worth and listing procedure. And then now coming to the what are the objectives of Indian accounting standards. Okay, why these Indian accounting standards? Because again, we are going to discuss in the upcoming slides also. I mean, without making any duplications. Still, I'll make you to understand what are the objective behind these accounting standards, where these are adopted. In fact, these are all not converged. In fact, I mean, these are not adopted. These are all the converged standards, so as to implement the internationally recognized best practices. Okay, that means these Indian accounting standards will help every company to have their to prepare their books of accounts as internationally desired, and the best practices. And compliances is not only restricted to a particular state or a particular country. Compliances or legal requirements are different from one state to another state, otherwise one country to another country. So that to achieve these recognitions, there should be some Yeah, sorry for the interruption. There was a technical issue now. Is it fine? Yeah. Can you hear me now? One has to confirm me. Yeah, fine. Right. Thank you very much. Right. Let me move on to the Let me move on to the slides. Can you see the slides now? No. 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 Is it happening? Yeah. Sorry for interruption. Can you hear me clearly? Yeah. Yeah, now we were discussing about what are the objectives of IAS, where uh, the annual financial statement and company's account should be transparent. That has to be achieved through this in the IAS. For that purpose only, these particular accounting standards are meant for. These standards are also harmonized. That means harmonized in the sense we have to maintain the uniformity to ensure that global requirement through these companies who are all operating across the globe, and expand their global scope as compared to the past. This is possible only when we have Indian accounting standards. Now look at the benefits out of having these convergence with the IFRS as in the manner of Indian accounting standards, right? Where several advantages can be seen where harmonization is possible. Harmonization in the sense we can find the uniformity, so that across the world, every nation, every country can read the accounting language in the same manner, okay, in generally, which can be acceptable by all, that is adoptable. I mean, the same context will be applicable to all nations, and the various investors can make decisions based on the uniform accounting policies. And also by adopting these standards, and companies which harmonize the accounting role, where it built through harmonization, where international base is very important. Okay, so that by having these Indian accounting standards, company wants to expand its business across the globe, which is helpful for them. That can be internationally expand its business, and global acceptance is always there because Indian accounting standards are converged IFRS, so that it guarantees the international recognition for all government institution and as well as agencies. And very importantly, compliances. Compliances is very always required for every nations, where if we have converged IFRS as in the main name of Indian accounting standard, definitely we will be considering the legal requirement of various nations, and accordingly we can tune up our accounting standards, and that would not create any deviations, otherwise would not create any sort of ambiguity in the part of investors and various stakeholders. So these are all the benefits we can expect from the Indian accounting standards. And again, some of these are very important reasons why the Indian accounting standards is required. Okay? For the economy, growth and development of industry, it is always Indian accounting standard is very much required. So when we would like to seek, would like to have listing our shares to seek foreign institutional funds, definitely it requires our books of accounts has to be prepared in the generally accepted by across the globe, so that it helps in that way for as we are in the moving towards globalization, and the standard policy initiation is always there, so that if we have a clear guidance, and while without ignoring any sort of accounting policies and conventions and concepts, and we are all looking at accounting language in the general manner, that means in the same manner, definitely it is resulted with the standardization. So there is a standard policy initiations there, so that Indian accounting standard is very much required. And new government policies will be come up, as we can see so many changes in the law related to taxation reforms, security laws. There are a lot of amendments related to Companies Act. Okay, these are all the new policies. So considering these new policies, Indian accounting standards should be renowned, and ultimately it resulted with it gives the clear indication for the stakeholders across the globe with the meaning of what exactly the financial statements give the as an output to for the decision making. Okay? So this is possible by having these Indian accounting standards. That means all policies, new acts, new legislations will be incorporated while designing the Indian accounting standards. And coming to the enterprises level, where it is benefit to the enterprises level, where they can expand their global markets, global funding can be, as far as global funding is concerned, there is a requirement for Indian multinational corporations, otherwise local corporations of India, have to list their shares. That means in the recognized stock exchanges, where as far as India is, okay, if we are following Indian accounting standards, our company's funding is possible. I mean, the benefit of funding can be obtained through the from exactly by the what do you call European countries, from the European countries, and as well as the UK, because IFRS is not applicable in United States. So that we have to again, if you would like to seek for foreign institutional investors, I mean, would like to what do you call listing in the US stock market, means certainly we should have US GAAP. Okay, so those are the extreme requirements also there in when we talk upon global funding. And competitiveness. So if we have accounting standards at the Indian accounting standards, definitely it would help to get the comparative advantage and competitive edge between the enterprises. Okay, and also quality and transfer, because competitiveness is very important at present, because to survive we have to be very competitive, and also our accounting standards should be accepted across the globe. There may be mergers and acquisition, there may be a business combination. This can be achieved only when we are supportive with these Indian accounting standards which are acceptable at global. And quality and transparency. If we speak on transparency, it is always there because there is always disclosures requirement should be incorporated in each accounting standards for every transaction which are be recorded in the financial statement has to be with the supportive notes and explanations so that it gives the quality and as well as transparency while reporting. And also we can say reduction of cost. Okay, when we prepare Indian accounting standards, we no need to prepare accounting standards for every country separately, so that Indian accounting standards are almost like IFRS with the due consideration of local laws, so that the same Indian accounting standards will be generally accepted by the various different countries, so that it reduces the cost of preparations of financial statement and conversion from one country to another country. And finally, it is very much beneficial for the investors for as these are all the reliable and reliable financial statements will be reflected in the common accounting language. And comparability is also possible because India and other countries' own accounting standards are more or less or an outcome of IFRS, so that the comparability is also possible and is. And before coming to the conclusion, let me share you some of the Indian accounting standards and some of the accounting standards still in the existing status. I mean, those are all not been converged with the IFRS, so those can be shown in the column accounting standard. You can find Indian accounting standard column heading and description. This is about description of Indian accounting standards, and next column is speaks on column heading accounting standard. These are all the existing accounting standards not been converged with the IFRS, so that they are in the accounting standard status. And title is nothing but what is the name of related to subject matter of the particular accounting standards, where these are all self-explainable when you look at the each one of the table column, where in the accounting standard 101 would speaks on a first time adoption of Indian accounting standard, where parallelly there is no accounting standard at present in local accounting standards. And India's 102, okay, 101 to 102, 103, 104 up to 116 we can find. Okay, these are all the converged Indian accounting standards, okay, from the IFRS. So like share based payment in 103 we can see business combinations, so the same can be. So there is no compulsory mandatorily applicable for all business organizations in domestic to have these Indian accounting standards, because Indian accounting standards applicability only when the net worth exceeds ceiling limit, right? So however, AS14 still it is there in the picture, because for other small and medium enterprises and those who would not come under the purview of the net worth status as in the mandatory purpose, then those can be used. I mean, they can adopt the follow the accounting for amalgamation. Okay, similarly 104 on insurance contracts, there are no parallel Indian accounting standards for that. Indian accounting standards are 105 speaks on non-current assets held for sale and discontinued operations. Parallelly, we can find accounting standard 24. So one thing we need to understand here, accounting standards are there in the old status or existing status. However, for them, there is a substitution of Indian accounting standards. More or less, they are the converged IFRS. Okay, so Indian accounting standard 106, 107, like that, up to 116, we can find lease. Okay, for even there is a accounting standard 19 which speaks on leases for the company which is not comes under the purview of the net worth ceiling limit. And beyond that, we can see in days 1 to as I said, there are 27 other not 27, 25 I think. Okay, there are Indian accounting standards are still in the old status. Those are all converged, need to be converged, and that means convergence is already been done. However, the applicability and adoptability and having these index accounting standard is left to the local market, local companies on voluntarily basis. If So that what they think is it would be anyhow, they won't look for foreign funding, otherwise they won't look for foreign institutional investors, otherwise they won't find any competition from across the globe, so that the local companies with the less than the ceiling limit will be restricting themselves to the old or existing accounting standards can be observed. Okay, these are all the various Indian accounting standards and accounting standards. Okay, you can find. Now, coming to the concluding remark, where to conclude, in this competitive world, it is inevitable to open our economy so as to find competitive advantage through mergers and acquisition with MNCs, having MNCs in local market, and also a joint venture to raise finance from foreign institutions investors by listing of financial instruments with the foreign stock market. This is possible only when we have uniform accounting language, which helps for comparability and also which bring transparency and also the solution. This can be achieved through the convergence of IFRS to Indian accounting standards, so that investment decisions also will be easily made by the foreign institutional investors. Okay, because it is very, even bringing what you call the foreign technology. Okay, for all these aspects, we should be having widen our accounting policies, which should be very much suitable for the global context. Okay, this is all about discussion. Now, is there? Before, I would like to say to you guys where I'm very much thankful to the management of St. Philomena's and organizers, Chandan and principal sir and father of the St. Philomena's, and all faculty and students who have been part of this particular webinar. Thank you, one and all.
Thank you very much, sir, for your vibrant and very informative session. I'm sure each one present here would definitely carry a lot of information on the subject. Ladies and gentlemen, in a short span of time, CMA Dr. Trinesh TR has covered the major areas of Indian accounting standards. But for the benefits of the members present here, the floor is open if you have any questions. You can kindly drop in your questions in the chat box below, and I'm sure Dr. Trinesh would answer that for you. So the first question is from Nikhila.
Paul, campus administrator of St. Philomena's Educational Institutions in their absence. I would also like to thank Father Julian for giving us his motivation. Special thank goes to Dr. Alphonsus D'Souza, principal of St. Philomena's Degree College, and Professor Vidyadhar Sanjay Nair, our vice principal. I would like to thank Mr. Ronald Prakash Cotino, our IQAC coordinator, Dr. Rina Francis, the Dean of Commerce and Management. I would now like to extend a special gratitude to our beloved resource person, CMA Dr. Trinesha TR.
Thank you very
This
much.
session has been really wonderful, sir, with you. I would like to thank our HOD and staff of BBA department for providing us utmost support and coordinating this event. Last but not least, I would like to thank all the participants, student volunteers, the technical staff and support who have joined the webinar, helped us through this webinar, and help us make this a successful one. Thank you all.
Thank you, Adil.
Thank you.
Thank you everybody for your wholehearted participation throughout the program. I request you all to follow all the COVID norms since the pandemic isn't over yet. Wear your mask everywhere you go. Do maintain social distancing. Finally, I would like to thank each one of you for joining us today. Thank you.